Hello, my name's Nathan Laird. I'm an analyst in the research team at Morgans. I've selected Sydney Airport to be my key pick within the transport energy infrastructure space. Sydney Airport is obviously a very well-known asset, but what's less well known about it is that the listed entity owns the lease to the Kingsford Smith Airport until 2097. And obviously it's the largest passenger airport in Australia. I consider Sydney Airport to be a very high quality, very well managed fortress-like asset within the infrastructure space. Its earnings are split roughly 50% between aeronautical, so aeronautical to do with international, domestic and regional passengers, the use of the runway, the terminals, etc., and 50% to do with commercial activities related to the airport, and that includes retail, property, car parking, ground transport, etc. International passenger growth is a real key driver of earnings and value for the airport. Interesting to note, international passengers only made up about 37% of the passengers coming through the airport in the last financial year, but contributed about 70% of the revenues of the airport. So obviously very important overall value driver. It's interesting, Sydney Airport puts out monthly traffic data, so you as a client can actually track the performance of the passenger growth over time through those passenger releases instead of having to wait for the half-year or full-year results. So it really gives you a chance to keep an eye on how things are going on that key value driver on a month-by-month basis. International passengers through the airport are very well diversified. They're diversified by the destination of departures by Australian residents, and they're also diversified by the foreign arrivals coming into the airport, and also by the purpose of travel. So that really helps to diversify that aeronautical exposure in the airport. The operating margins of the airport, very high, around about that sort of 80% EBITDA margin, so very strong on that front. The cash conversion of earnings, very strong at around about 100% cash conversion of EBITDA into cash flows. So that's something that really sings to the quality of the earnings coming through. The balance sheet, very strong, credit rating of BBB+. That puts it in line with the likes of Transurban and Horizon. It puts it ahead of APA Group and means that it's actually 3 notches into the investment grade credit rating. That's really important for the airport. A very good quality, very strong credit rating means they can source debt from very efficiently, which they use to fund their growth projects within the airport. Stock at the moment is trading on a sort of a mid 4% cash yield. Now look, I expect the earnings of the business to be able to grow over coming years at a mid-single digit compound growth rate, but I'm expecting the distribution growth to be slower than that, more like around about a sort of a 2% sort of growth rate. And the reason for that is the airport's not currently paying tax at the moment, but it's going to start paying tax in 2022. So I expect the distribution to be smooth or have a glide path into that tax-paying period instead of growing strongly and then being cut when when the tax starts being paid. While the start of tax means cash flows out of the company, it's actually beneficial in some ways for investors because that means that franking starts being generated and being attached to the distribution. So you get that franking credit benefit coming through from 2022. Look, the stock, no doubt about it, has benefited from strong international travel growth thematic. It's also benefited from the ultra-low government interest rates that we have seen both domestically and internationally. So the stock at the moment, I think it's very solid, high-quality asset for the long term, but I also think if these low bond rates remain, then I think there is valuation support for the stock. Even above where current share prices are. So certainly remains my key pick within the transport infrastructure space. Thank you.